GDP. GDP stands for Gross Domestic Product, and it is the most widely used measure of how big and how healthy an economy is. It adds up the total value of every product made and every service provided in a country within a single year. If a country's GDP is growing, it means businesses are producing more, people are spending more, and the economy is expanding. If GDP is shrinking for 2 quarters in a row, that is the official definition of a recession. Governments, investors, and central banks watch GDP more closely than almost any other number because it gives the clearest single picture of whether an economy is moving forward or sliding backward. Inflation rate. The inflation rate measures how quickly prices across the economy are rising. When inflation is high, the same amount of money buys you less than it did a year ago, which means your purchasing power is falling even if your income stays the same. Central banks typically aim for an inflation rate of around 2% per year because a small amount of inflation is considered healthy for a growing economy. When inflation runs too high, like it did in many countries in 2022, people struggle to afford everyday essentials, and the central bank usually responds by raising interest rates to cool things down. When inflation falls too low or turns negative, that is called deflation, and it brings its own set of problems because people delay spending and the economy can slow sharply. Unemployment rate. The unemployment rate tells you what percentage of people who want to work cannot find a job. A low unemployment rate is generally a sign of a strong economy where businesses are hiring and people have money to spend. A high unemployment rate signals that the economy is struggling, businesses are cutting back, and fewer people have regular income coming in. Most economists consider around 4 to 5% unemployment to be a healthy, natural level because some degree of job switching and searching is always happening in any economy. When unemployment drops too low, it can actually push inflation higher because businesses compete for workers and raise wages, which in turn pushes up the prices of goods and services. Interest rates. Interest rates are set by a country's central bank, and they are one of the most powerful tools available to control the economy. When the central bank raises interest rates, borrowing becomes more expensive, which means people take out fewer loans, spend less, and businesses invest less, which slows the economy down and usually reduces inflation. When the central bank cuts interest rates, borrowing becomes cheaper, people spend more, businesses invest more, and the economy tends to speed up. This is why every central bank announcement about interest rates moves financial markets so dramatically, because rates affect the cost of mortgages, car loans, business loans, and even government debt all at the same time. Consumer Confidence Index. The Consumer Confidence Index measures how optimistic or pessimistic ordinary people feel about the economy and their own financial situation. It is collected through surveys that ask people whether they feel good about spending money right now, whether they think their job is secure, and whether they expect things to get better or worse in the next few months. When consumer confidence is high, people spend more freely and the economy tends to grow because consumer spending drives a huge share of most economies. When consumer confidence drops, people hold back, save more, and spend less, which can slow growth even if the underlying economic numbers still look fine on paper. This indicator matters because how people feel often becomes self-fulfilling. Trade balance. The trade balance is the difference between how much a country exports and how much it imports. If a country sells more to the world than it buys from the world, it has a trade surplus, meaning more money is flowing into the country than going out. If a country buys more from the world than it sells, it has a trade deficit, meaning more money leaves than comes in. A persistent trade deficit is not automatically a bad thing. Many large and wealthy economies run them consistently, but it can put pressure on a country's currency and signal that domestic industries may be losing competitiveness against foreign producers. Purchasing Managers Index. The PMI, or Purchasing Managers Index, is a monthly survey sent to purchasing managers at hundreds of companies asking them whether business conditions are getting better, worse, or staying the same. The result is a number. Anything above 50 means conditions are improving and the economy in that sector is expanding. Anything below 50 means conditions are worsening and the sector is contracting. What makes the PMI particularly useful is that it comes out very early each month, often before most other economic data, so investors and governments use it as an early warning signal of where the economy is heading before the official numbers confirm it. Government debt ratio. The government debt to GDP ratio compares how much a country owes in total debt to how much it produces in a year. It is expressed as a percentage. If a country has a GDP of $1 trillion and a total debt of $1 trillion, its ratio is 100%. A lower ratio generally means the country is in a stronger financial position and has more flexibility to borrow or spend during a crisis. A very high ratio means a large portion of government income goes toward just paying interest on the debt, leaving less for public services, investment, and emergency spending.